1. Every major bank in America owns life insurance. Not to sell to you, to hold for itself. More than $225 billion of it sitting quietly on their balance sheets right now. It's one of the largest asset positions in American banking that almost nobody outside the industry has ever heard of. Bank tower exterior, slow push in too. So the first question is simple. Do banks really do this? Yes. It has a name, BOLI, Bank-Owned Life Insurance. It sits on the balance sheet under a heading as unglamorous as other assets. It's disclosed publicly in every single annual report, and almost nobody ever reads that page. Text card, BOLI3. Which banks? Bank of America leads, reportedly holding more than $24 billion in life insurance assets. Wells Fargo follows with over $18 billion. JPMorgan Chase, more than $12 billion. Those three alone represent a meaningful share of the national total. But this is not only a giant bank story. 3 logos, figures animating up 4. Because smaller institutions do exactly the same thing, at their own scale. BOK Financial reported $422 million at the end of 2025. Flagstar Financial, $1.6 billion. Washington Trust in Rhode Island, $115 million. Miami's own USCB Financial, roughly $59 million spread across 5 separate carriers. Scrolling 10K excerpts highlighted lines 5. Keep going, and the pattern just holds. Bankwell in Connecticut, $54 million. Bank of the James in Virginia, $24 million. That identical line item appears at PNC, Truist, US Bank, Fifth Third, Regions, KeyCorp, M&T, Huntington, Citizens, Comerica, Zions, and Synovus. Trillion-dollar institutions and small-town community banks doing precisely the same thing. Logo grid filling in 6. So why life insurance when a bank can invest in almost anything on earth? Treasuries, mortgages, corporate bonds, commercial real estate, municipal debt. There are 3 reasons. Every one of them is boring. And for an institution managing other people's deposits, boring is the entire point of the exercise. Number 3, title card 7. Reason 1 is taxes. The cash value grows tax-deferred, year after year after year. That growth flows into non-interest income with no tax bill attached to it. And the death benefit eventually arrives entirely income tax-free. A corporation paying full tax on every single bond coupon notices an arrangement like that immediately. Tax form dissolving 8. Reason 2 is stability. It isn't marked to market every quarter. When interest rates jumped, bond portfolios handed banks enormous paper losses. That's the lesson of 2023, and it contributed directly to real bank failures. Cash surrender value, by contrast, simply sits there and grinds quietly upward. Jagged line versus smooth line 9. Reason 3 is the one almost nobody mentions, and it's by far the most important of the 3. The asset is deliberately matched against a specific liability the bank already owes. This is not a bet on markets going up. It's a bill being paid in advance. Balance scale, 2 sides 10. Banks promise deferred compensation and supplemental retirement benefits to their senior executives. Those promises cost real money for decades into the future. The policies exist to offset exactly those employee benefit costs. That's not my interpretation. The filings state it in plain, unambiguous English, year after year after year. Highlighted filing text 11. So understand clearly what this is not. It's not a savings account. It's not a wealth-building engine. It's not where the bank parks its profits or grows its capital. It is a funding vehicle for an obligation already sitting on the books, and nothing more than that. Red X over Piggy Bank 12. Which brings us to the question that actually matters to you. Is this the same product as the indexed universal life policy an agent is showing you across a kitchen table? No, it is not. And I want to be very direct about that, because the pitch is everywhere right now. Split screen, bank versus sales brochure 13. Roughly 77% of bank purchases go into general accounts. The insurance company's own bond portfolio, with a declared crediting rate and a guaranteed floor underneath it. More than 93% of institutions holding BOLI use that structure. It is deliberately, almost aggressively conservative by design. Pie chart, 77% wedge 14. Larger banks add separate accounts holding treasuries, agency mortgage-backed securities, and investment-grade corporate debt, frequently wrapped so the book value doesn't swing with the market. Index-linked policies are a rounding error in this space. The entire design philosophy here is predictability, not upside potential. Asset breakdown bars 15. So when someone tells you that banks store their money in indexed universal life, they're describing a category of product those banks largely did not buy. Ask to see the actual filing. It's public, it's free, and it takes about 60 seconds to check for yourself. Magnifying glass over document 16. Then what's the honest takeaway here? That permanent life insurance can be a legitimate, tax-efficient, long-horizon asset. Serious institutions reached that conclusion decades ago and have never reversed it. That part of the story is completely real, and it's genuinely worth understanding properly. Calm, neutral B-roll 17. But banks buy under conditions you almost certainly do not have. A single large premium so very little disappears into commissions and early policy charges. Corporate tax treatment, 40-year holding periods with no need to touch the cash. Annual credit reviews of every carrier involved, 4 icons in sequence 18. They also answer to the OCC, the Federal Reserve, and the FDIC, all of which publish detailed supervisory guidance on managing this exact asset. Their board reviews it annually. Their auditors test it. You, sitting at that kitchen table, answer to absolutely nobody. Regulator seals, then empty kitchen table 19. So ask sharper questions. Show me the guaranteed column, not the projected one. What does this cost me in year 1 versus year 20? What happens if I stop funding it in year 6? What are the surrender charges, and how many years do they last? Questions appearing as text lines 20. And ask what should come first, the employer match, the Roth, the health savings account. For most households, those win, and they win easily. Banks own life insurance because it solves one specific problem elegantly. The only question worth answering is whether it solves yours. Closing card.